Good afternoon, ladies and gentlemen. My name is Akshat Mehni, and I am a research assistant at the Institute of Chinese Studies, New Delhi. It is a matter of great pleasure to extend a warm and humble welcome to all to another edition of the ICS's Wednesday seminar titled EU-China Relations, Navigating Perilous Paths. Before I proceed further, there's a short announcement. Unfortunately, due to ill health, Professor Manmohan Agarwal will not be able to chair today's seminar. Team ICS wishes him a speedy recovery. We are pleased to announce that Mr. Santosh Pai will step in as the chair. Today's seminar will examine the current sentiments of European businesses in China and their future outlook, based on a recent business confidence survey of the 1,800 member companies of the European Union Chamber of Commerce in China. Additionally, it will address the increasingly tense trade agenda between the European Union and China and its implications. The presentation will assess the current state of this relationship, explore the root causes of these tensions, and attempt to predict the potential future trajectories of EU-China relations. Joining us as speaker today is Mr. Jens Eskelund, who is the Chief Representative of Maersk in the Greater China area and Northeast Asia. He has been the President of the EUCCC since May 2023 and was the former Chairman of the Danish Chamber of Commerce in China, as well as the Maritime Working Group of the EU Chamber of Commerce in China. Earlier, he served as the General Manager for Public Affairs for the Maersk Line in China and later as the Director of Public Affairs for North Asia. He holds a Master of Arts in Philosophy and has studied at the University of Aarhus and the University of Texas at Austin. He has also pursued studies in Chinese at Renmin University in Beijing. His primary focus areas comprise engaging government entities, institutions, trade associations, and Chinese enterprises on matters of policy, regulatory environment, decarbonisation, and business development on behalf of the companies within the Maersk Group. Joining us as chair and discussant today is Mr. Santosh Pai, a cross-border lawyer, dual qualified in India and the United Kingdom, who offers legal services to foreign investors in India, including those from China and Taiwan. He is a partner at Denton's Link Legal, an Indian law firm, a member of the core group on China of the Confederation of Indian Industries, and treasurer and honorary fellow at the Institute of Chinese Studies, New Delhi. His areas of interest include Chinese investments in India, India-China comparative law and policy, cross-cultural negotiations, and board governance. His publications include Arbitration Law and Practice in India, 2021, and Legal Guide for Taiwanese Investors in India, 2023. He has also co-edited the book titled Chinese Legal System, 1979 to 2021, published in 2020. Before I hand over the floor to Mr. Pai, I would like to lay down a few housekeeping rules. All participants shall be muted during the presentation. You may post your questions in the chat box. Alternatively, you may use the raise your hand option during the interactive session. Please do remember to mention your name and affiliation while asking your question. Thank you, and over to you, Mr. Pai.
Thank you, Akshat. Thank you, Jens. Welcome again. Thank you for joining us. We are very lucky to have someone as well networked and someone from Beijing speaking to us on the business sentiment, the economic situation, and of course, a little bit of the geopolitical situation that's facing European businesses in China. And I had a chance to go through the report of the Business Confidence Survey 2024, which made for extremely interesting reading. It's a very well-designed survey which has been running for many years and it's highly regarded. So we hope you'll be able to, add a little more than what's in the report between the lines to enlighten our audience. A bit of background, most of our audience is across India. Earlier exchanges between India and China were far more frequent, especially on the business and cultural aspects. But now exchanges are reduced because of the political tensions. So this is again why someone like you can add extremely useful insights to our audience. So we request you, of course, to present the main findings of the survey along with your own personal perspectives. And also, while doing so, if you could touch upon certain aspects which are very interesting from an India perspective, such as European companies looking for alternative destinations or suppliers and supply chains moving out of China as part of the China Plus One strategy, and also the regular issues which faces business organizations in China, like market access, public procurement. So all these are common to Indian businesses as well. So that is my only request. And going for the as for the structure of this discussion, I think if you will get the chance to make run through your slides, which look interesting. I got a glimpse of it. And after that, I will use my prerogative as the chair to pose a first set of questions to which you can respond. And after that, we will open up the floor to the rest of the audience. Akshat will help me to source questions from our YouTube channel as well. So we hope to occupy you for about 90 minutes. So I hope this makes for an interesting session. So over to you, Jens. I think you can start your slideshow so that Akshat can confirm it's visible clearly.
Yeah, first of all, thank you for that generous introduction. It's a pleasure for me to have the opportunity to address you today. And in particular, I think being a European company, I think it's very interesting to talk to an Indian audience, because a lot of the discussion that are taking place today about supply chain security also has an increasingly an Indian angle. Now, I just want to make sure that you can all see my presentation and that it's in full screen mode. Is that the case?
Not yet. We can still see the smaller slides at the side, just as before. So maybe you have to refresh it once more to get the full screen mode.
I will try and refresh it one more time.
Yeah.
I seem to have a few. Okay, I will try again here.
Sure.
Does it work now?
Not yet.
I will just try a last time.
Okay. Otherwise, we can also request Akshat or Vikas to project the slides. Do you have a copy of it?
We have a copy of the presentation. Mr. Eskelund, in case you need assistance, we can project it from our side.
Yeah, okay. But it is actually full screen on mine. But I don't know if it is.
I think the share function is not working because right now nothing has been shared with the audience. It's
Okay.
not just the view. So maybe you can choose the window again.
Share screen. Here we go. Share.
Yes. Now we have a shared screen, and I think we can just carry on. It's still in the previous view with the smaller slides on the side, but it's fine. We can see your main slide very clearly. So please continue.
Okay, we will do that then. Okay, first of all, thanks for having me. I have given it the subtitle Navigating Perilous Path, and that suggests that there is a security angle to it. But I'm going to talk mostly about trade. And I think the reason that I've chosen to talk mostly about trade is that when we talk about security from a European perspective, a lot of it has to do with economic security. And I think in that respect, the relationship between Europe and China is fundamentally different from the one between the United States and China. Most notably, there's no superpower rivalry. Europe is not aspiring in any way to limit China's opportunities to grow and develop, but it's more about, from a European perspective, given what we are seeing right now in terms of rapidly increasing and very competitive Chinese exports, how can Europe ensure that it over time will retain a viable industrial base? And I think this is really the core now of concerns in the bilateral relationship now between Europe and China. This very sharp acceleration in export and concerns about across vitally important industries, whether Europe will be able to retain its position as a leading continent for industrial manufacturing. Now, there are several root causes for that, and that's where the business confidence plays in, because what we are seeing is that a lot of the things that are driving this very significant growth in exports, that is actually the state of the domestic Chinese economy. So let me start with a few words on business confidence. What we are seeing right now, which is actually a little bit of surprise, is that we are having the lowest business confidence on record. We have done this survey for 16 or 17 years. We are always, except for one new question.
I'm sorry to interrupt you. I think as you're changing the slides, the main slide is not changing on our screens.
Okay.
I can see you have started.
I'll stop there and log on again.
Okay.
Apologies for these technical issues.
No, that's completely all right, because your graphs are extremely useful to explain what you're saying. So I thought it's important we have that in front of us. Yes, now we are on the correct slide. Please continue.
Very good. And as you can see here, business confidence is at an all-time low over the 16 or 17 years that we have done this. We actually have more than two-thirds of our members who are indicating to us that business has become more difficult. But it is not necessarily because we are seeing an increase in market access restrictions and other barriers to trade. A lot of it has to do with the state of the domestic economy. Do you see my new slide now on domestic economic Chinese slowdown?
No, Jens, it's not moving to the next slide. Maybe you should just continue speaking, and I'll request Vikas or Akshat to project the slide. Does that make sense?
Yeah. Did it change now? Do you have one?
Yes, it changed. Yes, please continue.
Okay,
yes,
let's try now.
Okay.
What I want you to pay attention here are the top three concerns. These top three concerns were exactly the same 1 year ago, also in the same order: China's economic slowdown, global economic slowdown, and United States-China tensions. What is interesting is that last year, our respondents were equally concerned about China's economic slowdown and global economic slowdown. But what you see here is a very, very significant increase in respondents who tell us that China's economic slowdown is by far the biggest concern. And I cannot recall over the past 16 years that we have had a higher jump than what we see here. 19% increase over last year in respondents who report China's economic slowdown to be the biggest. And that really tells something about the state that the Chinese economy is in. 68% reported that macroeconomic factors had a negative impact on their company's net profit margin last year. What has changed also is that companies are becoming less optimistic. Did the slide change?
Not yet. We're still on the same slide. Now it is, yes.
Yeah, okay. EU businesses are cautious about the future. What we are seeing is that it is a record low proportion of our members who responded that they are expecting growth in their industry. And what is interesting here is that a lot of the figures that we saw, they are a little bit worse than what we saw in 2015 and 2016. But if you remember, what happened in 2015 and 16 is quite similar to what we see now. We had, a stock market that performed very, very poorly. We had overcapacity across many industries. We have a decline in the value of the renminbi, and we had real estate also doing poorly. It's a little bit the same dynamics we see, but actually an even less optimistic or even more pessimistic as it is. What is notable here is that whereas 32% of respondents are expecting growth, it is actually only 15% that are expecting to grow profitably. Do you see my next slide now?
Not yet.
Okay, I think I have a workaround here.
Yes, I think you've mastered this.
Good. Yeah. What is happening now is that European companies are beginning to adapt to these lower expectations, and we have a little bit more than half of our companies that are now indicating that they are going to cut costs, and a quarter of all respondents, they indicate that they're going to do that by reducing headcount. And this is of course a problem of China. You are in a situation with weak economic fundamentals. The last thing that you want to do is to see is that companies are beginning to lay off staff. But it's the reality that we are seeing now that a great many of our members are actually considering reducing headcount. These poorer fundamentals are beginning to change also China's attractiveness relative to other destinations, and I think this is where India becomes interesting. We have seen over the years that China has been perceived as relatively more attractive compared to other countries, but what we are seeing this year is that presently it is actually only 15% of respondents that regard China as a top investment destination, only 13% that regard it as a top investment destination for the future. So what is happening is that even though many companies still regard China as a top 3 or top 5 destination, what we can begin to see is that companies are increasingly begin to look around. And where we see them look around, there are 3 primary places where they are looking around to diversify their presence. It is Southeast Asia, it is India, and then it's a return to Europe. You see it also expressed here. And you can see that it's a trend that is actually gaining momentum in this year. You can see it's about 1/3 of our members who are now continuing to either shift their investment elsewhere or considering to shift their investments elsewhere. If you look at future investments, it's even more pronounced. It is actually only 42% of our members are considering now to move their investment outside of China. These are the highest number we have seen of records on the record of companies that are looking to expand outside of China. This very much has to do with several things. One is, of course, the shocks that we saw during COVID, where Shanghai was closed down for more than 80 days. When you look at it from a container perspective, and my day job is in container shipping, China exports about 1/3 of all containers in the world. The Yangtze River Delta exports 1/3 of China's export. So it's 1/3 of 1/3 that comes out from the Shanghai area alone. If you take 1/9 of all goods being exported at the world and take them out of global supply chains for 80 days, then you have a big problem. And what we have seen is that a lot of companies, they have begun to ask themselves, is it too dangerous for me to put all eggs in one basket? So that has been, for many of our members, a primary driver. Another driver, of course, has been geopolitical tension, where we have seen American customers putting companies here under pressure to move production outside of China. We have seen Chinese buyers, customers demanding that there's no US components to it. So we are beginning to see a silification. We are actually seeing more companies that are onshoring more of their supply chain into China than offshoring their supply chain. But it is really an expression of the same. And that is that China, in many ways, is becoming less globalized. We have companies that are increasingly having supply chains that are China-specific in China for China, and companies that are having supply chains for the rest of the world separately from the China supply chains. It is not yet the dominant picture, but there is a clear trend towards it. But I think there's one thing that is certainly also relevant for India. That is, I actually don't think that it is necessarily security concerns that are the biggest driver of the changes that we see. A lot of what we see is driven by differences in labor cost. And what you can see on the left-hand side is that labor cost in China has increased dramatically over the past few years compared to other countries in the region. So China is beginning, and actually to some extent encouraging, that low value-added labor-intensive manufacturing is moving out of China because China is simply getting less competitive. But when we look at it on the right-hand side, China's ability to climb the value ladder and claim a bigger share of global value-added manufacturing, China has actually done extremely well. And as you can see, now China is capturing about a third of total manufacturing value added. It is the same as United States and the European Union together. So I think this is actually a success of Chinese industrial policy. All the low value added is beginning to move out. China is increasingly beginning to claim the high value added. China is getting in on Korea and Japan and Germany's game. And this is probably, after all, the biggest driver of diversification, that China is moving out of low value added increasingly. Now, a little bit about overcapacity, because overcapacity is the big thing that is really ruffling feathers right now. For the first time, we asked our members about the overcapacity situation. And there are some of our members for whom it's not relevant. If, for example, if you are a law firm or if you are in financial services, overcapacity in manufacturing is not relevant. But as you can see up here, there were actually more companies that responded that overcapacity is a problem than responded that it's not a problem. So we believe that overcapacity definitely is for real. It's a term that China very much dislike, and the president has made a point of trying to sort of discount the concept of overcapacity. Our position in the EU Chamber of Commerce has been that, you know, we don't really care whether you call it overcapacity, but what we see in the market is we are seeing an increase in inventory levels, we are seeing deflation, we are seeing falling producer prices, we are seeing lower capacity utilization, we are seeing a squeeze on profit, and we are seeing market share erosion. Now, normally, these would be counted as symptoms of overcapacity. But if you prefer, you can also call it low domestic demand, or you could call it overstimulation of the supply side. We don't really care. What is for sure is that the consequences are real and they are felt by our members. You can see it expressed here that of this majority of our members who responded that they see overcapacity, 71% of them responded to us that it is beginning to bite into their profits, and 42% are into their prices, and 42% says that the prices have actually declined significantly. We are also seeing that it's beginning to affect the ability of European companies to keep their market share. And we can see a full 42% report to us that they have been losing market share to domestic competitors. In particular, sensitive or policy priority areas have been areas where European companies have been losing market shares. It's pharmaceuticals, it's IT and telecom, and it's machinery standing out. All three of these are areas that China has singled out for special policy support. So no surprise really that we're beginning to see market shares eroding. I should say, however, also, as you can see, that 29% of our members, they have been gaining market share. So it's not universal that everyone is losing out, but the trend is that companies are losing market share. Now, the big thing, low domestic demand right now, because we actually think that the reason that China is exporting so much is because demand is not picking up in China. The ironic thing is that the savings rate in China has never been higher than it is today. So the money is there. But Chinese people, they are reluctant to spend. A lot of it has to do with the fact that 70% of Chinese household wealth is tied up in real estate, And as we know, the real estate market is not doing well. And when there's doubt about the sort of continued value of people's nest egg, people will necessarily be less prone, have less desire to spend. Stanford University, they did some surveys over time, as we have done it, looking about how Chinese economists feel about how Chinese families feel about their family economy. And as you can see here, it is fairly dramatic how much worse the perception has become when Chinese families, they look at their economy today relative to 5 years ago. There is actually a reduction of 30%, almost 1/3 of respondents who indicate that their economy is much better or somewhat better than it was five years ago. So a dramatic drop in companies, in families who feel that they're economically better off than 5 years ago. If you look at how Chinese people think about their neighbors, they actually think that other people are worse off than they are themselves. You see a drop of 40% of people who think that other people were better or somewhat better off 5 years ago compared to today. But again, we should be careful about sort of making it all about pessimism. I think what we see here about the future, there is a significant drop also in optimism about how families think about the economic situation 5 years from now. But it is still close to 50% of Chinese people who feel that they will be better off 5 years from now compared to today. But overall, a very significant drop in the way that families, they perceive their own situation economically. Now I'm going to talk a little bit more what is happening in trade term and why European companies are feeling as squeezed as they do. As we know, the real estate sector is performing very poorly, and the estimate is that there are 70 million more apartments than the country needs right now. This is almost the equivalent of one empty apartment in China per German citizen. So what we are seeing is that it doesn't make much sense to invest more in property. And what we have seen instead is that we are beginning to see credit that was previously allocated into property being allocated towards industrial manufacturing. And we can see that in particular areas where Europe has particularly been pretty strong are areas where investment is going right now. I think if you take the two up here, electrical machinery and equipment manufacturing and car manufacturing, these are the top two areas of German manufacturing. And you can see when you compare to real estate that these are areas where you really see an increase in investment. Machinery is probably the most German thing you can think of in terms of industrial manufacturing. And it's mind-boggling to think about that 1 year ago, Germany's export of machinery to China grew by 0.8%. But Chinese exports of machinery to Germany increased by 20%. So, of course, it's only a matter of time before you have an inflection point and Chinese exports of machinery to Germany will overtake exports going in the other direction. Now, this is a problem also because in particular areas that are receiving policy support are growing very dramatically. And you may have heard about this term, the Big Three. The Big Three are the most prominent industries in these so-called new quality productive forces. And we can see that this investment towards high quality manufacturing is now beginning to manifest itself in much higher production levels. What is the problem in China and what has been a problem in China for the past 20 years is that when the government goes out and point to specific areas, industries as being priority industries, as the so-called Big Three or New Three, it is almost like the kiss of death. We saw 10 years ago how the solar panel industry was designated a priority industry. And within a few years, there was an amazing boom and bust cycle where everyone invested in solar panels, after which they went bust. We saw it in the semiconductor space where billions and billions of dollars had been wasted. And we see it now in this area here. Battery productions, hundreds of billions of dollars have been invested, but utilization of battery factory is only 55%, very low level. China today has a car production of capacity of around 44 million cars, but only 21 million cars are being sold on the domestic market. Now, production capacity of 44 million cars doesn't mean that China is producing 44 million cars. China is probably producing around 28 million cars. But if you can only sell 21 million cars domestically, it means that 7 million cars need to get exported. And that is, of course, the problem right now. Wind is also an issue. Last year, China produced 100 gigawatts of wind turbines, but the domestic installation only reached 47 gigawatt. I actually hear in the market now that if you want to buy a Chinese wind turbine, you can get 5 years deferred payment. 5 years deferred payment. I mean, how can you compete on this on those terms? As of last year, Europe was still a leader, but I think European wind industry will be. And of course, you have also an Indian wind industry. But you know, how will you be able to compete with 5 years deferred payment? And I think that is one of the issues that we are beginning to see so much tension. You see it also here in the case of Germany. This shift that we have seen in the ability of China to grow at the expense of, in particular, German exports globally. And you can see across all these key areas, whether it's chemicals, whether it's power generating equipment, whether it's machinery, vehicles, or electrical equipment, that Germany, and it actually goes for all of Europe, but Germany has steadily been losing volumes while China has been able to grow very significantly and grow into basically a dominant position. In particular, within clean tech, it's very obvious, and you can see here that across a lot of these categories here, from solar modules, solar cells, battery cells, lithium, nickel sulfate, all the supply chains in green tech, that China is the de facto world leader. And that's again one of these areas where Europe, with a pledge to decarbonize, to become carbon neutral within relatively few years, that this creates very, very significant implications for European companies, and in particular to grow within green industries. But Europe is by no means the only place that sees significant trade deficits with China. It is very much a universal problem. If you look to some of the other countries in the region that are big trade partners of China, also whether it's Mexico, Vietnam, Philippines, Singapore, Thailand, you see there again that China has a very significant surplus, and that very much, of course, also goes for India, where I think that in 2022, if my memory serves me right, bilateral trade was about $120 billion, of which only $17 billion were Indian exports to China, and a bit more than $100 billion went the other direction from China to India. And this is, unfortunately, part of China's economic model right now, because property is doing so poorly, because domestic demand is so low because of the factors I discussed before. The place really where China can grow its economy, that is through export manufacturing. So we need to expect that, you know, China will continue to push out high quality, very competitively priced product. That's of course very good if you're a consumer, but if you're a European company, if you're an Indian company, this will put these companies under increased pressure. Let's take solar, for example. The price of solar panel year on year is down by 60 to 70%. And that is, of course, the root cause of sort of the tension that we see today, that, can the world really continue to absorb more Chinese exports? I think it's according to the IMF, China accounts for 31% of global industrial manufacturing, but China only accounts for 14% of global consumption. So 14% of consumption, 31% of manufacturing. That gap, can that really grow even wider? And that is, of course, the question. But then, of course, the question you might ask yourself, is it a problem for European companies if it's just European companies manufacturing in China and then exporting to Europe? And it is actually becoming a problem, because what we can see since the heydays after China's WTO accession, but before the global financial crisis, that the share of exports that are coming from foreign funded enterprises has been steadily declining. It was almost 60% 15 years ago, but it has declined to only about 30% now. And when you look at industrial sector employment and a percent of industrial sector sales, it is down to 20%. So the idea that it is foreign companies, producing in China and exporting to the rest of the world, it doesn't really hold longer. Foreign companies are increasingly being squeezed out by domestic competition. And meanwhile, and this is important, imports are stagnant. What we see in the case of many countries, India is one of them, Mexico is also one of them. I mean, you have a trade balance of about 1 to 6. I think Mexico is 1 to 11. Europe in volume terms is 1 to 4. In volume terms, it's a little bit better. But what we have seen actually is that pre-COVID, every time Europe sent a container to China, China was sending 2.7 containers to Europe. 2022, when supposedly we had the largest trade deficit ever, it has grown that discrepancy to 1 to 3.5. Last year, when supposedly the trade deficit in value terms decreased, the volume discrepancy actually also increased to 1 to 3.75. That has to do with the fact that we see deflation in China. The products are getting cheaper, so you can squeeze more stuff in for the dollar that you spend. And my expectation is that the discrepancy will increase to 1 to 4 over the course in this year. But what I think is a real story, that is that all the while, if you go back to 2017, 7 years ago, the Chinese economy has probably grown about 35 to 40% in that 7-year period. But European exports to China has actually decreased by 30% in absolute numbers. How can that be? That in an economy growing 35, 40%, that your imports are actually down by 30%. And a lot of that has to do with industrial policy, with import substitution, with lack of access to public procurement for European companies, and so on. And this, I think, is one of the real true sources of attention. You see it illustrated on this chart here, the difference between volume and value. And what has happened basically since 2021 is that the correlation between value and volume export, that has become decoupled. And I think this is very, very important, because what matters to companies is not just the volume, no, not just the value, but also the volume. If you get a higher value, but at a lower price, that means actually that products are becoming cheaper, competition is getting stiffer, and companies are losing money. And that's what we are seeing right here, that it looks as if, value is dropping, but in reality, more product is going out. This is also going to put Indian companies under pressure. But one thing to keep in mind when we talk about these dependencies and this growth of Chinese exports to the rest of the world is that when you look at this one here, I actually think that India and the European Union has quite a bit of leverage. If you look at total Chinese export and the countries that are importing it, the big countries are basically, it's United States, it's the European Union, it's Japan, it's Korea, it's India. So it's a fantasy to think that China can simply continue to grow its export simply by shifting exports from Western markets, from India, from Korea, and Japan, and Australia to the global south, because the global south will simply not be able to absorb these very large trade deficits that India, Europe, and United States has with China. It is simply not possible. And I think this is one thing that needs to be a part of the conversation, that countries like India, like Europe, like United States, they need to realize that as dependent as we have become on Chinese green tech, on imports from China, the flip side of that coin is that China has become equally dependent on these markets. And this, I think, serves as a great basis for having conversation about some of these things. And this leads me to the concluding slide. Going back to the survey, China is being perceived as a comparatively less attractive market for foreign companies relative to just a few years ago. Economics, arguably, and labor arbitrage is a bigger driver for diversification away from China than geopolitics, even though geopolitics and supply chain security certainly are also very important factors. Weak domestic demand is seen as the key issue for foreign businesses in China right now. Chinese people have actually stopped buying products at the level they did before. And if you want to be a little bit provocative, you can say that, you know, what was the sort of the motto of the past years? China, in China, for China, perhaps has become a little bit of a liability because the demand growth is actually outside of China. So you can say if you invested everything in China, for China, this maybe might put you at some disadvantage compared to if you are in China for global markets. And in spite of that, this weak demand, what regrettably that we see is it continued to be the focus of politicians to support the supply side instead of the demand side. What we need to see is Chinese families feeling more confident about their future, feeling more confident that they'll be able to put their parents through their retirement, that they're able to put their kids through school, and that they are able to weather any health emergency. But unfortunately, we do not see a lot of investment to that. Because of that weak domestic demand, because of the low confidence in the economy, unfortunately, a lot of these products, that oversupply is getting exported, leading to trade tension as we see today. My expectation is, and our expectation in Maersk is that Chinese export, China's share of global exports is actually not going to fall in spite of all that. China is so enormously competitive across many sectors that we don't expect trade to actually fall. Its share of global trade. There might be some adjustment as we see some countries, perhaps in connection with China +1, that they take and move one factory to Vietnam or Thailand or wherever to avoid tariffs in the United States or such. But that just means that components will then be exported from China to Vietnam for assembly and then further export to America. So we don't really see Chinese exports falling. However, we are concerned about continued weak consumer demand, continued weak imports. And that again leads us to, gives us fear that we are going to see an increase in trade tension, and that we will begin to see an increase in trade tension. And I could be a little bit afraid that, you know, it feels like a slow-moving train wreck. We have seen the European Union embarking on a lot of investigation and of probes. We have seen China coming out and threatening retaliation, that we could, if we are not careful, get into some sort of doom loop where everything gets into a sort of negative spiral that it could be difficult to get out of. So now the question we have to ask, is it possible for us to find an off-ramp where we will continue to trade without getting into to this negative spiral? What is different this time is that it's not something that Europe will be able to do itself. China will need to accept, to recognize that Europe also has legitimate concerns and will need to adapt to these. The question is whether there's political will in China to do so. And I think that would be the big question that we have in front of us. This sort of concluded the presentation, all I had. Thank you for your attention.
Thank you, Jens. That was an excellent presentation. invitation. And as you had promised, you covered far more than just the survey. You went into trade patterns and gave us many, many insights. So thank you. I thoroughly enjoyed that presentation. So now I have a few questions. As I had also promised earlier, I'll try to push you a little beyond what is contained in the survey to give us a sense of how some of the global events are influencing on the ground situation in China. So my first question is, you clearly made clarified in the first slide itself that the US-China relationship is focused on security, but EU-China is mostly trade related and the tensions are building up on the trade perspective. So I take that point, but I have a related question on whether within the European Union, is there a committee? Is there a sort of agreement on dealing with China? Because on Xi Jinping's recent trip to Europe, we saw an attempt being made to kind of divide some European countries and deal with them directly, not as a bloc, but maybe Turkey, Hungary may not be very significant economies. But do you see this kind of, because I know your survey doesn't address it at the nationality level, but do you see Germany, Netherlands, France, and Italy, all of them, the companies from these countries having a more or less common ground in what they're doing in China? Or are there outliers, both at the country level or even at the company level? Because, Tesla is a very good example. While US is going heavily, going down on China, Tesla is going and actually tying up with Baidu for a self-driving vehicle and doubling down on China, so to speak, because I suppose for Tesla, it's a question of global market share. They can't really afford to lose in China. So that's my first question.
Yeah. Okay. I think, as far as European companies are concerned, there's no one size fits all. And you have, of course, the likes of German automotive, for whom China is existential, and they are doubling down on investment because they know that if they are not able to bring the best product to China and be at the cutting edge, then they're going to lose out. Then you have another big group of companies, and they are the ones that are looking at diversify their supply chains, exactly because they are concerned about geopolitics and supply chain security. Typically, also large companies who can afford to have two separate supply chains. Then the biggest group presently, small and medium-sized European companies, are the ones that are right now sitting on the fence. They are waiting right now to see which way developments are going, and will perhaps later on take a decision. But I actually think that about half of our companies, they are right now undecided on what exactly the future will be. And then, of course, you have the so-called China Plus One model that Chinese companies are also using, where they go out, selectively establish one production facility outside of China for the purpose of servicing third markets that might be closed for imports from China. And then you have the last group of companies that are typically in digital space or other sort of high sensitivity areas that have chosen that China is simply not for them. So I think it's important to understand that European industry is a little bit all over the place, and there's not a uniform answer to that reply. But I also think it's important to keep in mind that European thinking has changed a lot over the past 5 years. It is only 5 years ago, the last thing the Juncker administration, before von der Leyen became Commission President, the last thing he did was to make a recommendation to Parliament that Parliament recognize China as a market economy. It is completely and utterly unthinkable that the Commission would propose today to recognize China as a market economy. So that has changed. Another thing that has changed also is that Europe quite openly now talk about reciprocity. And also Europe is beginning to talk about economic security. So even though it might look like there's a lot of sort of divide and conquer, I think we also need to look at it from a bigger picture perspective and recognize that a lot of things have changed. It is, of course, true in places like Germany that the automotive sector is very, very powerful. But I think actually in the sort of broader population, the the sentiments towards China have turned very negative, and that is not least due to what happened in the context of Russia's war on Ukraine. And I think that is one thing that really has had a significant impact on public sentiments in Europe.
Yeah. Thank you, Jens. My next question is, building on what you said about the China plus one strategy. You mentioned alternative destinations like Southeast Asia, India, and also maybe returning to Europe are the three main trends that you're observing. My question to you is, are there any signs on the ground of retribution from China through either enforcement or some kind of a gray measure? Because many of us in India observed that immediately after Foxconn announced some of its investments in India, we noticed that iPhone was forced to engage a new Chinese supplier as a key manufacturer of iPhones. It looked like retribution. So, is there any sign that the Chinese government agencies are signaling to European companies saying, if you pack up your investments or if you don't expand as planned, there could be retribution, and this retribution could be legal or it could be softer, like public procurement measures and so on. Are you seeing anything on the ground?
It's actually very interesting because over the past 2 or 3 days, we have seen 2 separate announcements by the Chinese Chamber of Commerce in the EU that mentioned that they have learned from Chinese authorities that China might retaliate or launch investigations into European export of dairy, of wine, of aircraft, and of large engine vehicles. I think it's actually quite interesting because the investigations that Europe has launched are actually all WTO compliant. It is done within the auspices of WTO. But this retaliation that is quite, explicitly retaliation is not WTO. So we actually have a situation here where Europe is trying to, play by the rules, but where China, quite openly say, if you do this, we are going to retaliate. But it is not related to Europe moving out industrial manufacturing. And again, it's important for me to emphasize that European businesses are not running for the exit. We don't really see sort of a big number of European companies leaving. We are seeing a number of SMEs moving out of China and not a lot coming in. But overall, I mean, investment levels are sort of stable. So it's mostly in regards to trade that we should expect retaliation. But then again, as I mentioned, in value terms, Chinese exports are 2-3 times larger than European exports to China, and in volume terms, it's 1 to 4. So if you look at it from a leverage perspective, it would seem that China has much more to lose than the other way around. And that, of course, also goes in the case of India. I mean, if you have 6 times more imports than exports, it would seem that sort of retaliation in terms of tariffs of Indian goods would not be a very successful way to go.
Thank you. That's very helpful that you're reiterating that retaliation and reciprocity might have a bigger role to play in trade flows rather than foreign companies invested in China and trying to move out. So that's very interesting. Now, my last question, or rather last theme I want to explore with you is, as a lawyer, I pay extra attention to laws. So on the positive side, I think China has tried to reassure foreign businesses through, issuing some minor legislations like the opinions of the State Council on optimizing business environment for foreign companies. And MOFCOM also issued a letter removing measures concerning unreasonable differential treatment between domestic and foreign investment. So are these just policy proclamations, or is there any, because you spoke about public procurement, how it continues to be a challenge in the renewable industry, but is there any sign at all in any other industry that China is actually having a charm offensive or trying to convince foreign businesses that if you stay here, you will be rewarded or you will not be discriminated against? So are there any positive actions like this? In your report, you have covered the visa issue and everything. It's easier, 12 countries have received visa-free access. So that's one measure. But is there anything a little more substantial than that the Chinese government is doing to convince foreign businesses to stay in China or expand?
You're absolutely right that they have been on a little bit of a charm offensive, and we've actually had in our business confidence survey 45% of our members who indicated that they have seen some market opening. Now, some of that has to do with the visa-free travel that applies now to 12 out of 27 EU countries. Some of it has to do with taxation regulations. And then there are a few specific industries where we have seen some openings. It's food and beverage, it is cosmetics, and it's financial services. But I think the problem with the 24 measures is that they only apply to foreign invested enterprises in China. It doesn't give you anything if you're sitting outside of China and you're trying to export into China. So that's again where I think we have some of the issues, that while a lot of these things, may satisfy EU companies in China, it looks differently when you are in Europe. And I think that is one of the problems that we have now, is that, where we can see some positives as companies in China. If you're sitting in Europe, it is increasingly unclear why it is a benefit for Europe to have European companies in China. If it's just European companies moving manufacturing from Europe to China, moving R&D from Europe to China, moving tax payments from Europe to China, what's really in it for Europe? And that's where I think the frustration is right now, and where, frankly, it's getting a little bit difficult for European companies in China. How can we explain the benefit case for Europe in having European companies in China? And that's becoming a little bit more difficult. But there's one thing I think that's important to keep in mind. I've been traveling a great deal in China over the past 2 months, and the level of meetings I get has been unbelievable. I can say that within the past 25 years, I've never had better access than I've had over the past 12 months. Party secretaries, governors, and so on, they all want to talk. They all want to attract investment. If you bring anything that can generate any sort of economic activity, then you're welcome. Now, that, of course, stands in contrast with a much more security-focused agenda in Beijing, where you have new data security regulation, you have new state secret law, you have a raft of other sort of security-related foreign relations law and other laws that speaks more to the security agenda. So it really feels a little bit like a split personality, whether you are in Beijing or you are out in the provinces.
Great. That's very insightful. I think so. There are reciprocal measures in law, but on the ground, they're still trying to charm foreign businesses and see if it works. That's very good. I'll take a pause here, and we encourage our audience members to ask many questions, especially students who are listening to this. So, Akshat, do you want to read out some questions? I can see some in the chat box, but I would prefer you to read them out if the speakers are themselves not wanting to read it out. Yeah, please, Akshat.
Certainly, sir. We have one question in the chat box right now. It is from Dr. Natarajan. He says, given the increasing dominance of China in high value added global exports, global high technology manufacturing, is it time for a reverse flow of Chinese investment into the European Union? Here, there is a current policy of de-risking emphasized by the European Union with regard to China, more belligerence towards China from the US and EU. These barriers are being set up in this regard. Why would you think that geopolitics is not the primary reason for such developments?
I think it's thanks for the question, and it's a very good question. I think it is perhaps a little bit artificial to separate trade and geopolitics, because at a certain point, trade politics also becomes security politics. But what we have seen actually with sort of the most prominent example of European legislation, the Critical Raw Materials Act, that stipulates that across 204 commodities, 64 that come from China, at least 1/3 of these needs to come from a separate location. We are talking about 0.4% of commodities being imported into Europe from China that are in scope of that Critical Raw Materials Act. So, it's a little bit more like a rounding area. But I do think, and that's back to your point, as Europe is increasingly feeling pressure on its industrial base, then you will see that trade policy increasingly will become security policy. I think the experience with European manufacturers in the solar industry being completely obliterated 10 years ago, that is hard-baked in the DNA of Europe right now. I don't think that Europe will accept that, a rapid deindustrialization because China is exporting its overcapacity. Europe will not be able to live with that it doesn't have a wind industry. So I think something will happen. And that's what I think that China needs to understand. That if China is not working with Europe to ensuring that some of these industries will continue to remain viable in Europe, then trade policy will become a security policy. We are still at a point in time, I believe, where trade policy is, or trade-related issues are sort of a main tenet of discussions. But I do foresee that unless some of these issues where European companies are being priced out on their own domestic market, and perhaps Europe are losing altogether manufacturing capabilities, that it might become a matter of security policy also. We have seen, for example, within shipbuilding, basically no ships are being built in China anymore. I mentioned solar, wind, it looks like it could go the same way, and so on. And at that point, you could argue if you have already lost the capability to manufacture ships, that is a security issues. So my call to China is also you need to take it seriously when Europe raises these concerns here, because the bottom line for Europe is, yes, we want to trade with China, but it cannot be at the expense of the longer-term survivability of the European industrial base. And that's the balance that China needs to work with Europe to find. Whether China can resist the temptation to just go in on all-out exports to Europe, that remains to be seen. Thank you.
Go on, Akshat.
Mr. Pai, Dr. Natarajan wishes to ask a follow-up question.
Wait 1 minute. Before that, I think our chair who is unwell and couldn't attend has sent a question. Would you like to read that out, Akshat?
Certainly, sir. So we have a message from Professor Agarwal. He says that China is making two changes of policy. One, moving away from labor-intensive exports. So exports to GDP ratio is declining. Will it go back to exports, but now if sophisticated items such as Korea did in the 1980s to electronics, etc., can the European Union benefit as part of the more sophisticated value chains? Also, could export capital goods for these more sophisticated goods? Second, it could move away from its export and investment intensive strategy. This is less likely, however, but it would imply less trade and lesser scope for European Union exports.
I think there are a number of good questions here. I actually don't think that China is moving away from seeing export as a main driver of the economy. And I think that you will see actually exports growing ahead of growth in the economy. So exports is actually, or has since 2021, I think, actually been taking an increasing share. But I think what is important is what I mentioned before, that the correlation between volume and value has been decoupled. And that is actually a bigger problem for industry from a competition perspective. If China can export more for less money, part of it has to do with the fact that probably the biggest financial problem in the West over the past 3 years has been a growth in inflation, whereas in China, the biggest problem has been deflation. So just in that difference between inflation and deflation between China and the West, China has probably gained a 20% cost advantage. So I do see now that in terms of generating economic activity, it is actually export very much that is one of the which is growing faster than other sector, but actually more so in volume than in value. And I think you're absolutely right that China will, and it actually has a very determined strategy. It goes all the way back to before Made in China 2025 to get in to more sophisticated manufacturing. And I think this is also part of the problem. Last time we had an overcapacity situation in 2015, 2016. The industries where China had overcapacity were not industries where China were competing directly head-to-head with Europe. What we are seeing now, because China has been moving in to higher value-added manufacturing, is that China is increasingly competing head-to-head with European manufacturers. And that means, of course, that European manufacturing is coming under pressure. And I think in particular in third countries outside of Europe's home market, that is a foregone conclusion that many European companies are simply going to lose. If you're sitting in Colombia or Peru, would you care if it's a German car or a Chinese car? I don't think so. What you care about is that you get value for money. And that's where right now, for the reasons I also mentioned before, differences between inflation and deflation and so on, and industrial policy, that China is just so immensely competitive. The second part of the question was about, let me just see. There was a part of the question that I didn't get around to ask. Or maybe I did.
No, I think Jens, I think you've covered it. We can move on to the next one, Akshat.
Okay.
Yes,
From Professor
we
Natarajan.
have 3 more questions, sir. Would you like me to take up all 3 of them, or would you like me to go one by one?
I will just go one by one. That's fine.
All right, sir. We have a follow-up question from Dr. Natarajan. He says that there is much discussion about deindustrialization in Germany and the European Union in general, owing to high energy prices and other geopolitical developments. This means that European Union investments out of the EU become more important. What are the medium-term prospects for domestic economic growth in the EU, and what alternatives to investments in China exist for EU companies?
I think we are looking at a period of prolonged low growth in Europe. I think a number of policy mistakes were made, and of course, the rapid increase in energy prices have been very hard on several industries, in particular, for example, the chemicals industries. I think today you're paying 4 times more per kilowatt hour in Germany than you pay in China. And if you are in a very energy intensive industry, obviously this is going to be painful. But I think it's important to keep in mind that it's actually not necessarily China that's the biggest problem when it comes to sort of retaining European investment in Europe. We have seen several initiatives in the United States, like the CHIPS Act and the Inflation Reduction Act. And I think in particular, the Inflation Reduction Act has proven very attractive to many European companies. And what we see is actually that the investment level from Europe into the United States is significantly higher than the investment levels into China. And I think this is one of the things that creates a little bit of consternation in Europe. Europe is not very happy, does not feel that United States is really treating Europe as a partner when it begins to incentivize European companies to invest in United States rather than investing in Europe itself. So I think it's actually a quite complex picture. And I think in China in particular, but perhaps also other countries, there is a tendency to look at Europe as sort of the wagging tail of Washington, D.C. And I think that's not the case. I think, again, there are certain frictions, there are certain contradictions. And I think that Europe increasingly, also in view of the highly uncertain outcome of the election, presidential election in November in the United States, that Europe will seek to see, at least in trade terms, to see if it can really make good on the intention to become strategically autonomous. I think in regards to security, strategic autonomy is still very far away. But I think when it comes to economic security, I think this is an area where you will see initiatives. I think the issue for Europe right now is that the money is not really there to do sort of heavy industrial policy as we see in the US and in China, and the mood is not for it either. Europe thinks generally that it's not the right thing to do. It's a race to the bottom if you want to sort of keep unprofitable companies afloat by simply subsidizing them. This is not really the way Europe wants to go. But if European companies are getting under pressure, the industrial base is getting under pressure, that could be the way that Europe feels that it has to go. Thank you.
The next question, yes, sir. The next question is by Mr. Ashutosh Vashish. He is a research intern at the ICS. He says, recently it was reported in The Wire China that nearly 40% of China's electric vehicle exports last year were sent to the European Union, thus triggering significant concern among European leaders. Even the head of IG Metall, Europe's largest industrial union, warned that the European Union is facing a quote-unquote creeping deindustrialization. So how do the European leaders plan to address this?
It's a very good question. I think the interesting thing to note here is that the majority of cars, EVs being imported into Europe, are either Teslas or European car brands. So it's actually not Chinese car brands, even though there's a lot of talk about BYD and other companies. That was back to my point again about what value does it create for Europe if European companies are producing in China and not in Europe. And that is what I think IG Metall is asking questions about right now. I think it's very likely that we are going to see tariffs coming up. And in that regard, I think the thing that Europe needs to ask itself is, why would Europe want to institute tariffs? What's the purpose? And what is sort of the longer-term solution that Europe is looking for? Because I think, implementing tariffs is just, a tactical tool, and it's not something that will necessarily change a lot of the ground. I would actually think that it would hit German EV manufacturers harder than, for example, BYD, because BYD have higher profit margins than German EV manufacturers. So the pain would be felt more by the Germans. I mean, it's for all cars manufactured in China, not just Chinese owned. It will also be the German EVs that are being hit by the tariffs. But I actually think that one possible solution could be that, and again, I'm just thinking aloud. I'm not sure whether it's something that regulators will consider. But we saw in the 1980s when countries were concerned about the Japanese car exports, that Japan introduced voluntary export restrictions. And I could imagine that when you see these very, very steep increases in EV imports into Europe, that there was an agreement that you would want to sort of bring that level of increase under some sort of control. And I think maybe that could be one of the conditions under which the Commission, and again, I cannot speak for them, but it could be one of the conditions to be satisfied for the Commission to reconsider the implementation of tariffs. So I think, the solutions are there, but it takes both sides to have these kind of thoughts. Right now, we talk about tariff and China talks about retaliation. I think that's only, 50% of the question. The latter part of the question we need to ask ourselves is, what would a solution look like that would actually work for both China and for Europe? And that answer is definitely not tariffs. Tariffs destroy value. It doesn't create value. I think that perhaps something like voluntary export restrictions could perhaps be a tool that you might consider deploying. Thank you. I should mention, by the way, that China, across a range of industries, have implemented such quotas. China likes to talk about comparative advantage, but the fact is, if you buy a liter of milk from a farmer, you pay 100% more to a Chinese farmer than a Danish farmer. But still, China has a regulation that 60% of all infant formula needs to be made 60% by milk coming from Chinese cows, not imported. So, they like to talk about comparative advantage, but when it gets to things like, food stuff, they're very good themselves at implementing quotas. So maybe that is something that China would have an understanding if other countries did something similar.
Akshat, you want to take the last question?
Certainly, sir. The last question is from Dr. Jayashri Bora. She's a visiting researcher at the Institute of Chinese Studies. She asks, I was wondering, when China is perceived as less attractive for foreign companies, how much of China's new action plan to promote more foreign investment, especially in high-tech areas, is favored for growth, such as computer chips, biopharmaceuticals, and advanced equipment, as a response to decreasing interest of foreign companies in China? And could it work as a catalyst to bring foreign companies back to China?
I think that is a very good question. And I think it is a question to which the answer contains a multitude of contradictions. Because you're right, these are areas where China would actually like to attract foreign investment. But at the same time, these are all areas, the so-called, new quality productive forces, where China is investing massively in R&D and in boosting domestic capacity. So these are areas where, yes, they want to attract foreign companies, but where we can also see that domestic competition is really heating up. Incidentally, the pharmaceutical industry is the industry where we saw the highest number of respondents in our survey, 93%, who told us that they have experienced restrictions on access to the markets. So I think really it's a bit contradictory. We see also in the chip space, for example, that China is investing literally hundreds of billions of renminbi into chips manufacturing, mostly legacy chips manufacturing. But I think, again, this means that even though China would also want to have foreign participation, that foreign companies increasingly will get squeezed out of that space also. Within automotive, for example, and a number of electrical appliances, China is still relying heavily on foreign manufactured semiconductors. China has an intention to ensure that over time becomes Chinese. So yes, they want to attract, but at the same time, we can see that there are very significant subsidies and policy support towards growing and developing a domestic industry in precisely these areas.
Thank you, Jens. Our Honorary Director, Professor Alkacharya, has a question. So I would request her to unmute and maybe ask the question. Yes, please.
Okay, thank you. This is going to be a very brief one because we have come to the end of the time. Plus, I think there have been so many issues on which, Jens, you have put so many interesting ideas out there and clarifications as well. Now, I was just, this is like a broad brush thing because you did refer to the United States and maybe the slight differences between EU countries and the US on this whole policy of tariffs. And now we are looking at a possible period ahead when more tariffs are going to be imposed on China. What would be the points of convergence and divergence between the EU and the US on this whole question of tariffs? I mean, does Europe subscribe to this approach to sorting out the trade issues and the trade problems?
Yeah, I think it was very telling that yesterday von der Leyen, the Commission president, went out after Yellen, the Treasury Secretary, has been out and calling for Europe to follow the United States in terms of imposing tariffs, in particular on green tech, where von der Leyen was very explicit in making the point that Europe's approach to tariffs will be quite different from the American approach, and it'll be very targeted. So what I think we should expect is that Europe will not go out and implement blanket tariffs, but China will look at specific industrial sectors where Europe is fearing deindustrialization. I think the American approach is much broader in the sense that it is sort of a way or an intention to very comprehensively restrict the continued growth of Chinese industry, whereas the European approach is to ensuring that within specific industries in Europe that you will retain a capability to produce within these sectors also 10, 20, 50 years from now. So therefore, much more targeted. And that's also where I think that if China is tactically smart, and unfortunately, I don't think China has been very tactically smart, because I don't think actually China needed to do a lot. China did not need to do much to sort of allay European fears about deindustrialization. But so far, China has been, proven unwilling to discuss solutions. But maybe it's just a matter of, the pain level getting up sufficiently high, and then, you have created the conditions for talking. So I think, we are probably going to see the Commission continue sort of adding more fuel to the fire, and then hopefully at some point when you have built leverage, you'll be able to sit down and address some of these issues. I think what is going to happen is that if China does not acknowledge some of these concerns and begin to work with Europe to address them, then China will actually be pushing the EU into the arms of the US. And that's a choice that China is making, because it will leave Europe of no other choice if China does not begin to take seriously these deep concerns that Europe has about industrial viability. So I hope that China at some point realizes that the time is now to have these discussions.
Well, thank you very much. That was, in fact, those are the kind of things that I also believe are really, I mean, there's going to be more pain before we start to see things sorting out. But the worry here really is that will Europe be able to stand up and deal with the Chinese pressures alone, or as you said, will be forced into the US arms? I think that is the big question. But thank you very much, and over to you, Santosh.
Yeah, let me just mention here, I actually think that is one of the biggest problems that Europe has had, a credibility problem. China has not really thought that Europe actually will have the strength, or that China would be able to divide and conquer and talk to individual member states, and then Europe will never get anything done. But I actually think it's changing now, and I think the Commission is very determined to make sure that things are changing now. And I think it's important that China is heeding that call. I actually, and just for this audience here, I do hear in some quarters that there is what looks a little bit like a receptiveness to some of these arguments that Europe is making. And I think maybe that sort of the hard stance that China is taking right now, as we also saw the Chinese president in Paris who denied overcapacity, maybe part of that is negotiation tactics. Because again, if you think you have the upper hand, or that you can improve on your bargaining situation, why would you go out and concede right now? So I think what we are seeing right now is really the battle lines being drawn, and then hopefully, so it's a matter of who got the most ice in the belly at the end of the day, and that would be very interesting.
Thanks. Santosh?
Thank you, Jens. I think we should close now. We have almost occupied you for 90 minutes, and I especially like the positive note you said that US, EU, and India, we consume so much of Chinese imports, so we do have leverage, and we need to find ways to work together. In India, we are always looking at how to reduce our dependency on China. So maybe for our next conversation, we will dig deeper into those kind of issues and see what your shipping statistics say about reducing dependency on China and who has been able to do it and what lessons we can learn. So thank you very much for joining us, and we hope to have you again back with us.
My pleasure.
Yeah, thank you, Jens. Bye.
Thanks for having me.
Thank you. Bye-bye.
Bye.
Mr. Pai, with your permission, maybe please draw the curtains of today's event. Thank you so much.
Sure.
With this, we come to the end of today's seminar. We thank Mr. Eskelund and Mr. Pai for gracing today's seminar with their presence and for giving us their precious time. We also offer our gratitude to the audience for sticking with us. The video of today's discussion shall be available on the ICS's YouTube channel. The ICS conducts seminars every Wednesday, and further information regarding these topics can be found on the ICS website. You may also subscribe to our newsletter for regular updates. Thank you for joining us.